Come to lease accounting. We'll just quickly revise the first page again. This is a new standard on lease accounting, and the objective of this standard was to bring a more faithful presentation of assets and liabilities in the financial statement of lessee and lessor. This standard would aim to bring consistency between those who use the leased asset and those who use the owned asset. Because right now, those who use the leased asset, their financial performance seems to be better than those who use the owned asset. Because if it is an operating lease, the asset does not reflect in the financial statement. So many of the financial parameters like return on capital employed, asset turnover ratio, debt equity ratio, they seem to be better than the companies which own the asset. Okay. It has been observed that there are so many companies which are very capital intensive, but they don't use owned asset. They use asset on operating lease, and the previous standard on leases said you don't need to capitalize the asset on operating lease. So therefore those companies got a lot of advantage in terms of performance indicators. But this standard has a major change, and that change is now in the books of lessee, except few exceptions like short-term lease or lease of low values, all operating leases will also be capitalized. Okay. So that is, you can say, the main difference between the old standard on lease and this new standard. The lessee would capitalize the asset under operating lease. In fact, this standard does not use the word operating lease or finance lease for lessee. Now for the lessee, the lease will be called a lease only. Okay. Either it is a lease or you are just receiving some services for which you are making the payment. Operating lease and finance lease terminology would be used in the books of lessor. And in the books of lessor, more or less the accounting will remain the same. But this standard is too much in detail because it says you have to read the contract and check whether a contract contains a lease arrangement. In the previous standard, it was not so much of in detail. It only says if the significant risk and reward of ownership is transferred, it is a finance lease, otherwise it is an operating lease. And it did not go into too much of detail of identification of a lease contract in a contract. So a contract may have lease contract, but it may not be called as a lease agreement. Okay. So if there is a lease agreement, one has to see in detail how do we apply this standard with respect to that lease agreement. Okay. Secondly, if a contract does not call itself as a lease contract, then also it may have an element of lease, and then you have to apply this standard. The objective of this standard is to bring consistency, because there are some companies who are enjoying the benefit. So now this standard will remove that additional advantage which companies using operating leases had. Now remember my word, this standard will have a huge impact on the profitability of the companies. Because companies who are charging the entire lease rental as an expense under operating lease, now they will have to capitalize it. And still they will charge depreciation and finance cost. So what we were charging earlier, lease expense, will be substituted by depreciation and finance cost. So it will have an impact in the profit and loss account, because there are so many companies, if you look around you, are using the leased asset. Say for example an airline company. Almost all of their aeroplanes, not 100%, but a large number of them are on leases. Is it right? Yesterday in the newspaper I read that Jet Airways have not paid the amount. The flight was about to take off, the lessor pulled it down and the passengers were said, now you go on some other flight. Right? And one plane is worth crores of rupees. They have got fleet of some 1,000 or 100 of planes. So imagine how much is the lease rental they are paying. Plus all the airport facility that they use. The counters that you see on the airport is on lease only. Is it right? Now look at the hospitals. Many equipment that are installed in the hospitals are on leases. Commercial complex like this Prestige Point. All these shops, offices, classrooms are on leases. Right? Of course we own the classroom. So, but there are so many other classes which are on operating lease. So now they will also have to bring the assets and liability into the books. Now the standard is very good in the sense that at many places lot of relaxation is given to you. Like for example, you can apply portfolio approach in case of leases, like you have purchased 20, you have taken 20 computers on lease. Many offices, if you see, there are so many computers, equipments. Are you required to apply this standard for each of those equipment? Mostly the answer would be no, but again it depends, which we will see. So if each computer is similar type, taken from the same lessor, then normally you can simply club those 20 computers and account as one lease item. Okay, this will save your efforts. So that is example I have written there, contract to lease 20 printers. And many times, in order to ensure substance over form, even though the contract, legal contract entered into may be more than one, but these different contracts may be combined into one lease contract. So in form there are 3 contracts, 4 contracts, but in substance they are one. So they will be accounted as one contract only. For example, a simple example I'll give you, which is printed in your notes also. You first enter into a contract for 1 year. Okay. First you enter into a contract for 1 year. Today. Let us write year 0. Today only you enter into one more contract with the same lessor. And what is that contract? After 1 year, I am going to take this asset on lease again for a further period of 1 year. So 2 contracts. You enter into a third contract also today, that after 2 years, I will take the same asset on lease for 1 more year. So don't you think in substance, it is one contract only, designed as 3, so that you can take the advantage of short-term lease, which is exempt from the standard. But the standard says now you see these 3 contracts in totality, don't you think they look like as if it is one contract only? Same lessor, same asset, same benefit you are going to derive. So therefore you can combine them as one contract. Substance over form is the hallmark of this standard. Okay. When can you combine? Now remember this condition for some theory questions. When can you combine more than one contract as a single lease contract? Contracts are entered into at or near the same time. Paragraph 1.4. Then second, the contracts are with the same counterparty. But you people are very smart. Instead of you entering into the contract, you will route the transaction through some related party. Okay. So the standard says contracts are entered into with the same counterparty or the related party of the counterparty. And one or more of the following criteria are met. These 2 are compulsory you have to fulfill. Same or near same time with the same party, and one or more following criteria are to be met. The contracts are negotiated as a package. As a package means overall how much amount I am going to pay. That is kept in mind while negotiating the contract. Even though you have signed 3 contracts, but the negotiation was done as if it is a single package with an overall commercial objective, and that cannot be understood without considering the contracts together, or the amount of consideration to be paid in one contract depends on the price or performance of the other contract. That means these are interlinked also. The price of one contract depends on price or performance of the other contract. So there is an interlinkages, and the right of use underlying asset conveyed in the contracts, or some rights to use underlying asset conveyed in each of the contract, form a single lease component. So in substance, it is a single lease contract. In substance, okay. Like this example which we had given. First you enter into a contract for 1 year lease, and then you enter into a forward contract to take the same asset for 1 more year from the same lessor. So this look like these are a single lease component only. They are not different lease. And in that case, even though in form you have more than one contract, in substance it is one, and treat it as one contract only. Okay. Now we'll see the scope of the standard. Up to this we had done in the previous lecture also. So that was a little fast forward mode. Now slow mode. Scope of the standard. The standard should be applied for all leases. However, there are some exceptions, and 1 or 2 exceptions are very important for you, like the exception on small value item, or those items where the lease period is for a small period of time. Is it right? So first exception is leases to explore for or use mineral oil, natural gas and similar non-regenerative resources. There is another standard on this. Okay. Under Ind AS 106 and under IFRS 6. The standard is called exploration for an evaluation of mineral resources. Okay. So that standard deals with this item. So when there is a specific standard dealing with a particular transaction, the standard says you go to that particular transaction or particular standard only. Then leases of biological asset which fall within the scope of standard on agriculture. That is 41 number. Okay. And within biological asset there is an exception. Biological asset that are bearer plants. Biological asset that are bearer plant. For example, a mango tree. A mango tree is a bearer plant because it bears fruits, are within the scope of another standard, property, plant and equipment, rather than agriculture standard, and consequently are within the scope of PPE standard. Therefore, for example, leases of bearer plant such as orchards and vineyards held by a lessee will fall in the scope of PPE standard. This is just for clarification. Bearer plant fall under PPE standard. Other than that, agriculture standard. So if you fall under these 2 standards, then they are outside the scope of then these items are outside the scope of the standard, those which fall under agriculture standard. But those which will fall under PP standard will come under lease standard, the new lease standard. Okay. First exception was exploration and evaluation. Second is biological asset under agriculture standard. Third exception is service concession arrangement, SCA. Revenue standard. Which standard deal with SCA? Revenue standard 15. Okay, or Ind AS 115. Then similarly, licenses of intellectual property granted by a lessor will fall within the scope of revenue from contract with customer. This is specifically covered in the revenue standard. Intellectual property licenses granted by a lessor, rights held by a lessee under licensing agreement, within the scope of intangible asset standard. Go to that standard. For example, motion picture films, video recording, plays, manuscript, patents and copyrights. One important point need to be discussed. This standard right now says we are more focused on tangible asset. With respect to intangible asset, the International Accounting Standard Board says we need to do some more research and discussion. So maybe in future, this is my observation, we will have two standards. One for leases of tangible asset and one for leases of intangible asset. So although the standard says you can use this standard for other intangible asset other than what is exempted here, but we are not focused right now on intangible asset which are given on lease. So you can continue to apply your intangible standard for that. A lessee is permitted, you can, but you are not required to apply this standard to leases of other intangible asset. So it's open statement now, you can apply, you may not apply. And why they have said that? This last paragraph on the screen here, although there is no conceptual basis for excluding them from the scope of this standard, the board means IASB. Here the board of studies means, board means IASB, not your board. Very dangerous institute. The board considered that a more comprehensive review of accounting for intangible asset is required before requiring leases of intangible asset to be accounted for under the new standard. Okay. So this is about intangible asset. So those which are specifically excluded, you don't apply the standard. But other intangible assets, like it's written in your note, brand, trademark, etc., you may or you may not apply this standard. So what we will do? Not apply. Is it right? Given a choice, what Indians do? Don't do anything unless it is forced on you. What about the leases on land, long-term leases of land? Again, here the IASB has come to a conclusion that such leases will fall under the scope of this standard, because many companies uses long-term lease of land. Now it will fall under the scope of this standard. What about leases of investment property? Is it excluded or included? Included. No scope exclusion in relation to investment property. What is investment property? One student will answer. Investment properties are land or building or both which are used either for earning rental or capital appreciation. Okay. That is investment property. I had given you a hint also on the screen that these are usually given on rent or for capital appreciation. All aspect of leases of investment property will be accounted as per this standard. Investment properties are something which are given on rent. So therefore this standard has to be applied for that. Okay. Basic accounting will be done under the respective standard investment property, but then the lease of that portion will be accounted under this standard. What about sub-leases? That is also covered. Sub-lease means you take an asset on lease and you give it on lease to another party. That is sub-leasing. Leases of right of use asset in a sub-lease will fall within the scope of this standard, subject to certain exclusions which will come later. Exclusions for sub-leases will come later. Sub-leases are required to be accounted in the same way as any other leases. What about leases of inventory? Does not specifically exclude leases of inventory from its scope. That means even it is also covered. But in practice, the inventories are not leased much. So they have not specifically said anything about exclusion. Whatever is not specifically mentioned about exclusions, they will be covered. But practically, why will somebody take inventory on lease? Because when you take something on lease, we actually use it, okay, to generate some benefit. Inventory means you use it and you have to again return it back. So you can't even sell it, you can't even consume it. But still, we have discussed that point. Inventory on lease is covered by the standard. This you tick mark, very, very important, because you will have some problems on this also. Short-term leases and leases of low value item. Point number 2.7. Is it there? 2.7. Now, why do you think these are excluded from the accounting under the standard? Although they are part of the standard, but you will not apply the normal lease accounting for such items. Okay, like suppose this is a calculator, for example. This is a calculator, for example. Its value is 300 rupees and we have taken it on a lease for 3 years. Why you are laughing? Suppose. Now you see how much time, effort and energy will go in accounting for such small value items. Because then if I strictly apply the standard, I have to calculate the present value of future cash flow. Then we have to divide the payments into interest portion and principal portion, which will unnecessarily complicate your accounting process. Okay. So small low value items are usually ignored. And similarly, leases for short term leases. Suppose you go to Goa, you take a bike on lease for 3 days. Will you apply this standard? No. Suppose you get married, you are about to get married and you have hired a marriage hall for 7 days. Will you apply this standard in detail? No, just pay the expense and charge it to P&L account. Okay. So short-term leases, leases of small value items, they are excluded. But you have an option here. You can apply the standard as it is. Most companies will not do that. But again, many companies are smart. They will do analysis and check which gives me more profit, which saves more taxes for me. And whatever may be their objective, accordingly they will decide whether to apply the standard for such item or just charge them to P&L account. So you have to understand there are some options available in the standard. You can do this or you can do this. And in future, once you become CEO, CFO of a company, you have to play with the numbers and see which gives you more benefit. Right? The major task now in the next 1 hour will be to identify a lease. Whether a contract contains a lease. Okay. So suppose you are using Jio mobile phone. So don't you think you have taken the telecom services on lease from Mukesh? Yes or no? Is it a lease? We will see. We will see. But that is a question. Is it right? In your office, you have a dedicated lease line, for example. That is called lease line itself. That is one way to provide you the service. The other way, you just take a telecom service on your mobile or for your offices. So this standard will now help you to understand whether this is a lease. Suppose I go to a bus stand and I take a bus and go to Mumbai. Is it a lease transaction? No. If I suppose take a car from some company and I use it for 1 year and every day I go to Mumbai, is it a lease transaction? First you said no, now you are saying maybe yes. So now if you look around you, everything looks like lease only. This is the standard now for next few minutes. Everything, when you pay something and you are getting some benefit, it looks like, can it be a lease transaction? Yes or no, both are possible. So we'll see some conditions they have given. Okay. And then subject to those conditions, it can be a lease, it may not be a lease. Okay. And therefore the standard will make a huge impact in the accounting in the next few decades to come, unless they change it again. So what is a lease? A lease is a contract. We have seen the meaning of contract on the first page. Contracts are enforceable agreement, or it is a part of a contract. It can be a part of a contract also. For example, I take this ship on lease. Example, we take a ship on lease. We also hire the services of the crew. We also ask the owner that you provide me maintenance service also. So that means these two will not be treated as a lease arrangement. But taking this ship or lease may form part of lease arrangement. It can be a part of a contract. The full contract may not be a lease contract. Normally what happens when we take some machines, building and such asset only, we also take repairs maintenance service from the party, the owner, because he knows the asset better, he knows how to maintain it, repair it. So in that case, we will have to divide the contract into lease and non-lease part. What we'll call it? Lease and non-lease. This standard applies to lease. It says we are only going to help you with the lease contract, lease part. We are not going to help you with the non-lease. So for accounting for maintenance service, you go to other standard. Whichever other standard are applicable, you go to that. So that is part of a contract. A lease is a contract or a part of a contract. Now this you double underline, that conveys the right to use an asset. What it conveys? The right to use. It does not give you the asset. It only gives you right to use. Right to use. This word will come again and again. Right to use. Okay. RTU. Right to use an asset, which we will call in this chapter underlying asset. As I said, the focus of the standard is on tangible asset. But it does not prohibit you from applying this standard to certain other intangible asset also. So it gives you the right to use the asset for a period of time and in exchange for a consideration. Okay. So what are the important features of a lease contract? It can be a contract or a part of a contract. It gives the right to use an asset for a period of time and in exchange for a consideration. That is called lease contract. So when you have to see whether a contract involves a lease or not, at least that basic feature of lease must be in mind. Right to use the asset for a specified period for a consideration, for some consideration. Determination as to whether a contract is or whether a contract contains a lease. Okay. If you take interest in this chapter, then you'll find it's very interesting, because as I said, now when you look around you, you will find a lot of things are actually having a lease kind of situation. When you take a bus to go to Mumbai, that is also like a lease transaction only, but it's for a very short duration, and therefore we just treat it as an expense. But if I ask the bus owner, this bus you give it to me, I'll use it for 5 years, and every year I'll pay you the rent, I'll use it to go to Mumbai every day, then it falls under this standard. Okay. So we have to now learn how to identify a lease at the inception of the contract. Underline the word inception. This meaning I will tell you after some time. Inception of the contract, which is just generally when you sign a lease agreement. That is called inception of a contract. When you normally sign a lease agreement, an entity is required to assess whether the contract is or contains a lease. So when are you going to check this? Whether a contract contains a lease or a contract is a lease? At the inception of the lease. Inception of the lease means when you normally sign the lease agreement or you become committed to the provisions of the lease agreement. That you will see later, little complicated. When you sign the agreement or when you become committed to the principal provisions of the lease agreement. That is called inception of the lease. On that day, the lessee and the lessor, they will sit down and check whether this agreement, this contract is a lease contract or whether this contract contains a lease contract. The contract itself is a lease contract or the contract may include lease contract. Okay. A contract is or contains a lease contract if it conveys the right to use of an identified asset for a period of time in exchange for consideration. So which are the key words here? Right to control the use of an identified asset for a period of time in exchange for a consideration. 5 points. First, right to control. And right to control what? Right to control the use of an asset. Use of an identified asset. What is an identified asset? We'll see in the next slide. Don't worry. The asset has to be identified. Which asset is given on lease has to be identified. Okay. If I go by a bus to Mumbai, there is no identified asset. I go there, I pay the price, whichever bus is going, they will make you sit on that. Right. But if I have to hire a place in this Prestige Point building, then they will specify this location, office number 101 on the east wing, first floor. That is the identified asset. Okay. So therefore, when I take a telecom service from a telecom company, it is not a leased asset. It is not a lease arrangement because there is no identified asset as such. For a period of time in exchange for a consideration. Period of time can be anything, but for simplicity purpose, normally less than 12 months are called short-term leases, and then you have an option, you need not apply the standard for such short-term leases. So what are the important things you will look into? First is the asset that is subject to lease must be specifically identified. Okay. Now, see one more example. Now in India there are many knowledge process companies, KPOs. Okay, knowledge process outsourcing companies. And they provide their employees pick up and drop facility. A cab comes in the morning to their home. The employee sits in that car, drops him. Again the cab picks up another employee. So company, that KPO company must have tied up with some company who provides the cab facility. Is the particular cab dedicated for a particular employee? No. You also know from your office, any day any cab comes, the owner of that cab company, he has got that facility, he can give you any cab that he wants. So in this case, the specified asset criteria is not met because he can easily substitute one asset for other asset, which does not cause him a significant loss. Okay. Then that is not a specified asset. But the MD of that KPO company says, I want this black Mercedes car only. Okay, no other car I want this only. Then this will become a specified asset. And then you may have to apply the standard. Okay. So when it is very easy to substitute the asset by the supplier, then it is not a specified asset. But when the nature of the asset is such that it cannot be easily substituted, it may be substituted, but then there will be cost involved, which is more than the benefit that you derive. Then in that case, normally it will be called as a specified asset. And a lease must convey the right to control the use. They are not giving you the control, they are giving you right to control. When it is transfer of control, it becomes a sale transaction. In your revenue standard, control is transferred to the other party. So that is one of the requirement for recognizing sale transaction. Control is transferred. But here you are not transferring the control. You are transferring right to control the asset. Right to control. Now what do you mean by control? Control means the party who has the control, he will decide when, how, where to use the asset. That is called control over the asset. When to use the asset, how to use the asset, where to use the asset. Of course, sometimes in case of leases, some minimum restrictions are there. What are the restrictions they can have? If you have given a ship on lease, then they will specify you don't have to go to these all locations because this is subject to a lot of pirates of Caribbean. Okay, or these are the areas where the cyclones are more common. So those kind of restrictions may be imposed. If you are given a car on lease, they will say you will only drive in the state of Maharashtra. Okay. In your car, you will not carry explosive guns and bombs. These are the basic restrictions they can impose. But otherwise, most of the economic benefit that will be derived from the asset is transferred to the other party. Then you have given the right to control the use of the asset. Okay. So now we will quickly discuss this line. How to identify an asset. So first check whether it is a lease transaction. If it is a lease transaction, then check the identified asset. Right to control the use of an identified asset. Right to control the use of an identified asset means right to obtain substantially all the economic benefit from the use and right to direct the use. If you have transferred these two things to the other party, then this standard will become applicable. It is a lease contract. There is an identified asset. The supplier has transferred the right to control the use of the identified asset. The other party, which we will call lessee, has a right to obtain substantially all the economic benefit from the use of the asset, and he also has a right to direct the use. Right to direct the use means I have told you how to use the asset, when to use the asset, where to use the asset, what you need to produce from that asset. That is your decision. So once the lessor gives me this property, this classroom on say rent, and now I will decide whether I have to teach accounts here or finance here, or whether I will open a study room here or whatever I want to do. Of course, you may put some kind of restriction which are called protective rights. Like for example, you will not create noise. You will keep the premise clean. That kind of restriction may be there, but otherwise all the important use of that asset I will decide. Okay. Then in that case it is a lease arrangement. Welcome to this standard. Okay. So let us revise once again. Check whether there is a lease contract. Check whether there is any identified asset. Whether the right to control the use of the identified asset is transferred to the lessee for a period of time for a consideration. Right to control the use of the asset means you have transferred the right to obtain all substantial economic benefit normally associated with that asset, subject to some protective restrictions, and the lessee has a right to direct the use of the asset. Okay. Now, when will you check all this? At the inception of the lease. The importance of this word inception is that on that day we have to decide whether the contract is a lease or it contains a lease contract, required for both the parties, lessee and lessor, because lessor also have to do the accounting accordingly. And for the lessor, now he will have to also check whether it is an operating lease or a finance lease on the inception of the lease. So an entity is required to assess whether a contract contains a lease at the inception of the lease rather than at the commencement of the lease term. Now there are two terms which are similar but not exactly same. Inception of the contract and commencement of the lease term. On the inception means agreement, or when the parties commit to principal provisions of the lease agreement. Commencement is when the asset is actually transferred to the lessee, and so that he can use it. So there can be sometime a gap between the two dates, inception date or commencement of the lease term. You will bring the asset and liability in the books on the commencement date, but you will decide whether the lease agreement exists or not, whether the contract contains a lease on the inception date. Okay. One student recently had asked me a question that what about the payment made between inception date and commencement date? Normally it will not happen. Suppose you signed the agreement on 1st January but you started using the property from 1st of March. Will you pay rent from 1st January to 1st of March? Normally no. But in case if that standard also says that, let us say you have to make some payment between this inception and commencement date, that also you capitalize as an asset and liability. Whatever amount is paid will be on the commencement date added to asset and liability. That will come in the next paragraph somewhere. This is necessary because a lessor is required to classify a lease as either a finance lease or an operating lease at the inception date. So on this inception date, both parties will have to decide. Lessee will decide whether it is a lease or not. For lessee, there is no operating and finance lease now. Lease, not a lease. For lessor, if it is a lease, he has to also decide whether it is an operating lease or a finance lease. In addition, a lessee is required to disclose information about leases not yet commenced, to which lessee is committed if that information is relevant to the users of financial statement. Now possibly inception of the contract is 29th March. Commencement is 5th of June. There is an year ending date, 31st March. So in that case, you may have to give disclosures about the lease which have been where inception has started or the inception is over but commencement is not yet started. So disclosures will be required. So this you will see in the disclosure part. For those leases where inception is over but commencement is not yet started. Now, lease versus in substance sale or purchase. When assessing the nature of a contract, an entity should consider whether the contract transfers the control of the asset as opposed to conveying the right to control the use of the asset for a period of time. What is the difference between the two? In case if the contract transfers the control of the underlying asset, then it will be accounted under other standard, chiefly revenue standard. In the revenue standard also you have seen control transferred, revenue recognition takes place. But if you only convey the right to control the use of the asset, then in that case it is a lease arrangement. So if the transaction is a sale or purchase within the scope of other standard, then the standard on revenue from contract with customer or standard on PPE will apply depending upon what is that asset. What about customer has control for only a portion of the term of the contract? If the customer has the right to control the use of an asset only for a portion of the term of the contract, the contract may be 10 years. Customer may have a right to control the use of the asset only for 5 years. So this standard is applicable or not? Applicable. For how many years? For 5 years. The contract contains a lease for that portion of the lease term. Because in case of leases, the contracts are designed in so many ways. Okay. Some of the big corporates, they have got more than 10,000 leases designed in different ways. Okay. So now this kind of companies will have a challenge because all those leases you have to reopen and apply the standard. So the transition here is going to be a big challenge for companies which have lot of leases. Okay, especially the lessee. Those lessors are already doing the same thing, so they don't have to worry much. But lessees will have to at least look at all those operating leases and then they have to move to the transition. Assessment required for each potential separate lease component. The assessment as to whether a contract contains a lease should be made for each potential separate lease component. So you have to read the entire agreement and see, are there potential lease component? Machine may be given on lease, some equipment may be given, maintenance service may be given, etc. So after that you have to identify whether a contract contains some lease agreement or not. These are all small issues they have covered. From exam point of view, this may not be very important. What if you have entered into a contract with a joint arrangement? Now let us ask somebody, which standard deals with joint arrangement? Under IFRS 11. Under Ind AS 11 plus 100. 111. Now when there is a contract contains a lease agreement, who is the customer? Is the customer the joint arrangement or is the customer the venturer or the parties to the joint venture? Who will be treated as a customer? Who will be treated as a lessee? The joint arrangement, that they have clarified. So if you are entering into a contract with a joint arrangement, then the joint arrangement would be the customer or the lessee, not the individual parties like venturers. There is no further discussion on this in the standard. When a contract to receive goods or service entered into by or on behalf of a joint arrangement, the joint arrangement will be treated as customer in the contract. Accordingly, when assessing whether such a contract contains a lease, an entity should assess whether the joint arrangement has the right to control the use of an identified asset throughout the period of the lease. Now, reassessment. What is reassessment? You are a student of taxation also. Reassessment. Terms and condition of contract may change. So what will happen if the terms and condition of contract may change? Possibly, a contract which did not contain a lease may contain a lease now. So an entity should reassess a contract is or contains a lease only if the terms and condition of the contract are changed. So every time the terms and condition of the contract will change, one has to again check, reassess whether it contains lease or not. Now next paragraph is identified asset. So this is another topic now, identified asset. This standard is applicable if the lease is for a identified asset. Okay. So first paragraph there, 3.3.1, the asset that is subject of a lease must be specifically identified. What you are taking on lease must be specifically identified. And this will be the case if either of the following applies. We are going to take some problems also after some discussion. Then you have to identify the asset. Okay. The asset is explicitly specified in the contract. This is a simple test that a particular asset is specifically specified in the contract. For example, suppose you are taking a building on lease. It is specified that I want this particular office or this particular building. Okay. That is, you determine what is the location, floor number, office number, etc. Then it is easy. Okay. In case of some assets like vehicles, there may be some number, registration number or engine number, something. Okay. So one way to identify specific asset, is there any explicit way like some number system through which we can identify? Or the asset is implicitly specified at the time that is made available for use by the customer. For example, when there is only one asset that is capable of being used to meet the contract terms. Okay. So sometimes it can be implicit. Supplier has only one factory. Supplier has only one factory. And the supplier has committed to allow you to use that factory for manufacturing purpose. So even though it may not be identified or explicitly identified, but he says we will provide you a facility to manufacture your products. And he has only one factory. So that is implicit in this case. Or any such example where you know that there is no other asset. That is the only possible asset that can be given by the supplier. Like in case of power facilities, they have a separate power facilities for specific companies only. Now this paragraph you tick mark substantive substitution right, because I have got 10 questions on this point afterwards. What is substantive substitution right? Can the supplier substitute that asset? Can the supplier substitute the asset? Like I give you example of a KPO companies where there is a company who owns a lot of cabs. They provide you a service that we will help to transport your employees from office to home. But do they provide any specific car to you? No. Even those who are doing articleship, they also get such facilities. Cab comes to their home, drops to the client place, again in the evening, from client place to your home. But you might have noted the same cab may not come every day. You will get a cab, but any cab. Okay. So in that case, he is able to substitute it easily. But suppose you have taken your office on lease. Your office is also on lease most probably. Can the owner say, no, tomorrow you take this office? Possible? Say no. No. Then in that case, it does not have substantive substitution rights. Okay. And that will determine whether you will apply the standard or not. Because if the supplier has substantive substitution right, it is not a lease. It is not a lease because there is no identified asset here. And then you will just treat it as a payment for services received. Then you will say, okay, I have just received some services and this is the payment for that services. Even if an asset is specified, a customer is not considered to have the right to use an identified asset, and therefore the contract is not a lease. Underline, therefore the contract is not a lease. If the supplier has a substantive right to substitute the asset throughout the period of the use. Now this is an important line. I am assuming you will underline. If the supplier has a substantive right to substitute the asset throughout the period of the use, anytime he can substitute. So even though the asset may have been identified at the beginning, but it can be substituted by the supplier, then the contract is not a lease contract. And what do you mean by period of use? Period of use means the total period of time that an asset is used to fulfill a contract with a customer. Total period of time that an asset is used to fulfill a contract with the customer, including any non-consecutive period of time. So sometimes there may be some break, but you can understand the period of time is the number of years for which the asset will be given to the lessee for use purpose. Now underline this also. If a supplier has a substantive right to substitute the asset throughout the period of the use, anytime he can substitute, there is no identified asset and the contract does not contain a lease. So very important, it may look like a lease transaction, but it is not a lease because the supplier can decide which asset to be given to you. He can change that asset. This is because the supplier and not the customer controls the use of the asset in such circumstances. Now, when do we have substantive right for substitution? Only if the following conditions are met. Now, you have to also see when you read the case study or a question that is it practically viable to substitute? Sometimes you may have the power to substitute, but practically it may not be viable. Like an office given on a building. You have given a certain office to a certain customer. You can't substitute him anytime you want. But if you have given some car, normal car, then in that case you can easily substitute. The supplier has the practical ability to substitute the alternative asset throughout the period of the use. Sometimes you may have the power to substitute, but practical ability may not be there. For example, the customer cannot prevent the supplier from substituting the asset, and alternative assets are readily available to the supplier or could be sourced by the supplier within a reasonable period of time. Is it right? That means, in simple words, it's very easy to provide a substitute asset without much cost, without much delay, and the customer has no objection to that. To the customer, I have promised I will send a cab every day, and that's it. Whether I send this cab or that cab, you don't bother. And second, the supplier would benefit economically from exercising its right to substitute the asset. The supplier should not suffer, you can say, a loss when it substitutes the asset. Okay. So normally what they do, if they have the right to substitute, they will manage the business in such a manner which is more profitable to them. If a cab driver is near your home, then the other cab driver who had dropped you yesterday and he is in Bombay, so what they will do? The one who is near to your home, they will call him, you go and pick up this customer. That is more economical to them. Is it right? That is, economic benefit associated with substituting the asset are expected to exceed the cost associated with substituting the asset. Then you have a power of substitution. It is easy and it is cost effective. Understood? Easy, simple, no time consumption, and it is cost effective also. But if you give an office to a customer in a particular location And then if you say I have to substitute, first of all, it is not practically possible. And even if it is practically possible, it may be more costly exercise also. Because then again, lot of other costs get involved in shifting. The customer will say, I want my cost of relocation reimbursed by you. Again, you have to enter into contract. Again, you have to pay registration fees, stamp duty, legal fees, paperwork. Okay. So that may be more costly affair. Now next is substantive rights. Substitution rights are not substantive. It is not likely or practically or economically feasible for supplier to exercise those rights. Right may be there. Practically not feasible, economically not viable. Then ignore it. Okay. Then it is a lease contract. In many cases, the supplier would not benefit from the exercise of a substitution right because of the cost associated with substituting the asset. Now, for example, many companies may provide satellite rights. Even though you may substitute it, but substitution is not practically possible or commercially or economically viable. Yes, satellite rights. You can hire satellite power also nowadays. Is it right? Or some companies may provide power services to you. Okay. But again, substitution of that may not be economically feasible. Then it is a lease transaction. Next paragraph is substitution on or after a specified future date or dependent on the occurrence of a specified event. So this is futuristic. In future, if this event happen, then we will substitute. What will you treat it as? Lease or not a lease? Future is uncertain. Is it right? So therefore the standard says if the supplier has a right or an obligation to substitute the asset on or after a particular date or after a specified event, the supplier substitution right is not substantive because the supplier does not have the practical ability to substitute alternative asset throughout the period of the use. Then it is a lease transaction. If it is a 10-year lease and the agreement says you can substitute after 5 years, then it is a lease contract. It has to be throughout the period of the lease. The substitution right should be throughout the period of the lease. If it is after some period or after some event, which means for some portion of this lease term, you don't have the power to substitute the asset. Next point, evaluation to be based on circumstances at inception.
Entire 10 years is this lease agreement or only 5 years is standard applicable?
Okay, good question. This gentleman is asking a question that whether this lease term is for 5 year or 10 year. It's a 10-year term. After 5 year it can be substituted. So my accounting will be applicable for 10 years. Accounting will be applicable for 10 years. Okay. Have you seen the meaning of lease term so far? Lease term not yet come. So when lease term will come, we will discuss your point again. Okay. Right now my topic is identified asset. Identified asset. Substantial right of substitution. If a supplier, this we have discussed. Evaluation to be based on circumstances at inception and to exclude consideration of future events not considered likely to occur. Same thing. An entity's evaluation of whether a supplier substitution right is substantive based on facts and circumstances at the inception of the contract. If it is based on some future event at the inception of the contract, are not considered likely to occur should be excluded from the evaluation. Future is uncertain, remember. So therefore you cannot use those future event for evaluation purpose. Example of such future event, ignore all this for evaluation purpose. an agreement by a future customer to pay an above market rate of use of the asset. Introduction of a new technology that is not substantially developed at the inception of the contract. A substantial difference between customer's use of the asset or performance of the asset and the use or performance considered likely at inception of the contract, or a substantial difference between the market price of the asset during the period of use and the market price considered likely at the inception of the contract. These events will not be considered for substantive right of substitution. If a supplier would benefit from substitution only in circumstances that are not likely to occur. Is it there in your note? If supplier would benefit from substitution only in circumstances that are not likely to occur, then those substitution rights are not substantive. There is a condition, but that condition is not likely to occur. Then you will say it is not a substantive right, and therefore this agreement would be a lease agreement, regardless of whether the circumstances are specified in the contract. What the standard says, substitution cost generally higher when the asset is located at the customer's premise or elsewhere. Now, basically these are what we can say application guideline. Practically, how do you know that substitution right is not there? Normally, if the asset is located at customer's premise or at some other place, substituting that asset would be a costly affair. And since it is going to be a costly affair, then the supplier will not substitute it, even though he may have the right to substitute. And in that case, you will say that this contract is a lease agreement. Okay. If the asset is located at customer's premise or elsewhere, the cost associated with substitution are generally higher when located at the supplier's premise, because you have to deinstall or uninstall from customer place, again install a new asset at the customer place. So that may involve time, cost, transport, loading, unloading, taxes, stamp duty, and all other legal and other procedural cost. So it is better not to substitute only. Therefore, are more likely to exceed the benefit associated with substituting the asset. So why we are discussing all this substitution? If the substitution is easy and cost effective, then the supplier has a substantial right to substitution. It is not a lease. If it is costly, difficult, practically not possible, economically not viable, then it is not a substantive right and it is a lease contract, assuming other factors are in favor of lease. Okay. Now many times you must have observed a supplier says, in case if the asset is not functioning properly or it requires an upgradation, then they substitute the asset. Then also it will be treated as a lease contract. A supplier's right or obligation to substitute the asset for repairs and maintenance. Sometimes I have found that for some days they will take away this asset and bring a different asset in that place. And in the meantime, they will do the repairs and maintenance work. Is it right? If the asset is not operating properly or a technical upgrade becomes available, then this does not preclude the customer from having the right to use an identified asset. So such kind of situation when the asset is substituted for repair, maintenance, upgradation, then it is still a lease. Okay, because the customer has a right to use the identified asset. Now, in order to simplify the standard, there is a provision on the screen. You can also understand. Customer cannot readily determine. There can be situation when you are not 100% sure whether the supplier has substantial right of substitution. Then what the standard says? Assume he has the right or he does not have the right. In case of a situation when you are not able to clearly distinguish whether he has the right of substitution or not, standard says assume he does not have substantive right and treat it as a lease transaction. So when in doubt, lease transaction. Okay. So if the customer cannot readily determine whether the supplier has a substantive substitution right, the customer should presume that any substitution right is not substantive. That means he will assume it to be a lease contract. Okay. Now there are some comment written. This is a comment on the paragraph. It should generally be relatively clear from the facts and circumstances whether substantive substitution rights are substantive. Normally it will be available. Normally when you enter into a contract, you know what you are entering into. Is it right? But then they are saying that customer should assess whether substitution rights are substantive if they are reasonably able to do so. A customer, the standard says, see, you are doing a business. You will not waste your time and energy in finding out whether he has a substantive right of substitution or not. Ignore and treat it as a lease. A customer is not expected to exert undue effort in order to provide evidence that a substitution right is not substantive. The standard setter also knows the mentality of a businessman. Okay. Just to apply the standard, he will not invest his time, money and energy whether the right is substantive or not. So you assume not substantive, treat it as a lease. So this is how the standard says. If in doubt, not substantive, treat it as a lease. What about the portion of the asset? This is a building. You may not take all the floors of this building on lease. So in that case, you can take a portion of the building also, portion of the asset also on lease. So a capacity portion of an asset is an identified asset if it is physically distinct. Then you will apply it for that portion, this standard. For example, the floor of a building. But many times it may not be possible to physically identify your portion. Next example below. A capacity or other portion of an asset that is not physically distinct. For example, a capacity portion of a fiber optic cable. Fiber optic cable, you can't differentiate your portion and other portion. Can you? No. Or a pipeline is not an identified asset unless it represents substantially all of the capacity of the asset and thereby provide the customer with the right to obtain substantially all of the economic benefit from the use of the asset. In items like this, fiber optic cable or a pipeline, if you are getting substantially all the economic benefit, then you can apply the standard. But otherwise, it is not an identified asset. And since it is not an identified asset in the second example, it is not a lease. Then what will you do for the payment made? Treat it as a payment for services received. Treat it as a payment for services received. Okay. A customer is unlikely to have the right to control the use of capacity portion of a larger asset if that portion is not physically distinct, because decisions about the use of the assets are typically made at the larger asset level. So the same example for this fiber optic cable, you cannot decide the use of the asset. One of the features is that you should be able to decide the use of the asset. If I take first floor on lease, at least I can decide the use of this asset. But if I have taken a fiber optic cable or a pipeline on lease, which is also shared by different people, then I will not be able to decide the use of the asset. Now the author has given some comment on these provisions of the standard. The determination as to whether an asset is physically distinct may not be difficult for items such as building. Like this is the building. Each one of us who has taken this premise on rent, we know this is our portion and we can use that asset the way we want. A floor of a building can be distinct, even though the ability to use depends on having access through common areas used or controlled by others. Of course, the right to access this building sometimes is affected because there is a common area. However, it may be more difficult to conceptualize for assets such as technology asset, like for example, satellites. Satellites are also given on lease because they help you to communicate, right? Whether there is a distinct portion that can be controlled, when the ability to use that portion may require access or power, say, from a portion that is not controlled. So in this case, when you are sharing an asset, then you have to see whether it is distinct or not. If not, it is not an identified asset. Ignore this standard. Okay. But if it is distinct, then it is an identified asset. Welcome to the standard. The right to control the use of an identified asset. So see, the topic is moving like this. First we have to see whether it is a lease, whether there is an identified asset. Now if the answer is yes, then right to use the identified asset. Right to use or right to control the use of the identified asset. Better term, right to control the use of an identified asset. Now, when do you have control over an asset? When do you have control over the asset? The right to obtain substantially all the economic benefit. Okay, and second, the right to direct the use of the identified asset. So, these 2 points you repeat again. First is you have the right to obtain substantially all the economic benefit. Not all, but substantially all. And second, you have a right to direct the use of the specified asset. If these two conditions are satisfied, it means you have the right of control of use of the asset. To assess whether a control conveys the right to control the use of an identified asset for a period of time, an entity is required to assess whether throughout the period of the use, the customer has both of the following. Both must be present. If both are present, then it is right of control of use. And then you will further proceed with the standard. First, you will get all the economic benefits, substantially all. And second, you have the right to direct the use of the identified asset. What do you mean by right to direct the use? The way you want to use it. How, when, where you want to use the asset. Of course, there may be some protective restrictions which is allowed by the standard. Like I gave you some extreme example. A ship is given on lease. You can't carry it to a certain location where pirates are there. Cyclones are more common. Is it right? Law does not permit you to take to those areas. So in that case, there are restrictions. You can't carry explosive, gun, bomb. Okay. If you are given a building, you can't make any alteration, okay, in the structure, the civil structure. So these are some protective restriction which may be there. Once again, the meaning of period of use. Period of use is the total period of time that an asset is used to fulfill a contract with the customer, including any non-consecutive period of time. Right to economic benefits from the use. First, it has to be lease, okay. Then there must be identified asset. Power to control the use of the identified asset. Power to control means we should have rights to substantially all the economic benefits. So now there is a comment on that also now. Customer must have the right to obtain substantially all of the economic benefit. To control the use of an identified asset, customer must have the right to obtain substantially all economic benefit from the use of the asset. For example, by having exclusive use of the asset throughout the period. Underline, for having exclusive use of the asset throughout the period. That means if the same asset is used by many people, then you don't have exclusive right. Then it is not a lease. To control this, I have read. In circumstances when an asset might be considered to be implicitly identified, for example, the supplier has only one machine capable of delivering the customer's requirement. This we discussed in the beginning, how to identify an asset, either explicitly or implicitly. Implicitly means the customer has only one asset. The supplier has only one asset. If the supplier can regularly use the machine for other purposes during the course of the contract, for example, to supply other customer, then the customer does not have the right to obtain substantially all the economic benefit from the use of that asset, and there is no lease. Now, this point I will explain again after some time, but understand, this standard will really be a game changer for many entities. How? See. Now, this is a factory. Okay. Factory. Now, this factory is used to manufacture output which is used by lessee or a person called L. 100% of the output of this factory is for L. You will think that it is a normal transaction. He is manufacturing, selling it to L. But then the standard says you have to read the whole contract, and possibly it is a lease arrangement because there is an identified asset and all the economic benefit of that asset belongs to L. L decide how much to be produced, which size of clothes should be produced if it is a cloth factory, which color combination, which product mix, what should be the delivery schedule. If all this is actually decided by L, then probably there is a lease contract. But if suppose this factory owner says 50% of my capacity I will use it for you, and remaining 50% I am free to produce and sell to others, then it is not a lease. Because then L does not have exclusive rights over this asset. It does not get significant or substantially all the economic benefit. So these are called hidden leases now. 90-10. Now the standard is always principle based. So you have to apply your judgment. They have used the word substantially. IFRS standards are principle based. Okay. So 90, 95, one has to apply the judgment. Now we'll take a small break.